Ever wondered how to value a company that isn't making profits yet? It's a common dilemma for investors, especially when dealing with startups or companies in their growth phase. Traditional metrics like the PE ratio fall short because they rely on earnings, which might be non-existent or negative for these companies. The PE ratio won't help you, but the price-to-sales ratio just might. This metric can provide a clearer picture of a company's valuation by focusing on its revenue rather than its earnings. Let's dive in and explore how you can use the PS ratio to make more informed investment decisions. Hey everyone, welcome back to the channel. If you're new here, don't forget to hit that subscribe button for more insights into financial metrics and investment strategies. Today we're talking about the price-to-sales ratio, or PS ratio, a super handy metric, especially for analyzing growth stocks, startups, or companies with low or negative earnings. This ratio can be a game changer when traditional metrics don't apply. So, what is the PS ratio? Simply put, it's a measure of how much investors are willing to pay for each dollar of a company's revenue. It's calculated by dividing the market capitalization of the company by its total revenue. The price-to-sales ratio tells you how much investors are paying for each dollar of a company's revenue. The formula is simple. PS equals sign market cap total revenue, or PS equals sign stock price sales per share. This straightforward calculation can reveal a lot about how the market views a company's revenue-generating potential. Let's look at an example. Imagine a company with a market cap of $1,000 and annual revenue of $500. The PS ratio in this case would be 2. If a company's market cap is $100 million and annual revenue is $50 million, the PS ratio is 2. This means investors are willing to pay $2 for every $1 the company earns in sales. When is it useful? The PS ratio is particularly useful in scenarios where a company has no profits, like early-stage tech firms or turnaround companies. These companies might be investing heavily in growth, leading to negative earnings but strong revenue growth. Unlike the PE ratio, it doesn't rely on earnings, so it gives a cleaner look at valuation in these cases. This makes it a valuable tool for investors looking to understand the revenue potential of a company without getting bogged down by its current profitability. But remember, revenue doesn't equal profit. A company can have huge sales and still lose money. That's why it's crucial to look at other factors alongside the PS ratio. A company can have huge sales and still lose money. High revenue doesn't necessarily mean a company is financially healthy. It's essential to consider other aspects like profit margins and operational efficiency. That's why the PS ratio isn't enough on its own. It should be used in conjunction with other financial metrics to get a comprehensive view of a company's financial health. So, what's a good PS ratio? There's no universal answer. It depends on the industry. Different sectors have different benchmarks for what constitutes a good PS ratio. There's no universal good PS. It depends on the industry. For instance, tech startups might have high PS ratios because of their future growth potential, while more established industries might have lower ratios. Investors are often willing to pay a premium for the promise of future revenue growth in these high-risk, high-reward sectors. Retail or manufacturing companies often have lower PS ratios due to thinner margins. These industries typically have more stable but slower growth, leading to lower valuations relative to their sales. Always compare companies within the same sector. This ensures that you're making apples-to-apples comparisons and not misjudging a company's valuation based on irrelevant benchmarks. Now, how do you use it smartly? Use the PS ratio alongside other metrics like profit margins, revenue growth, cash flow, and debt levels. This holistic approach will give you a more accurate picture of a company's financial health. A company with a low PS and growing sales and improving margins? That's interesting. It indicates that the company is efficiently converting its sales into profits, making it a potentially good investment. But a low PS with flat or falling revenue? This could be a red flag, indicating that the company is struggling to grow its sales, which might be a sign of deeper issues, might be cheap for a reason. Always investigate why a company has a low PS ratio before making any investment decisions. To recap, the PS ratio shows what you're paying for a company's sales. It's a valuable tool for evaluating companies with unclear profits, but it should never be used in isolation. It's great when profits are unclear, but always dig deeper. Look at other financial metrics to get a complete picture of a company's health and potential. If you found this helpful, drop a like, subscribe for more breakdowns, and let me know what ratio you want next. Your feedback helps us create content that's tailored to your needs.